Want a clearer read on where interest rates are headed next? The latest Fed minutes offer clues that can move yields, mortgages, and markets long before the next forecast drops. The Federal Reserve has published the record of its January FOMC meeting. This is the deeper conversation behind the short policy statement. Investors study it to gauge how close the Fed thinks we are to stable prices and maximum employment, and how that judgment could shape the policy rate and the balance sheet in the months ahead. Here's what stands out. The discussion drills into inflation details across goods, services, and wages, and compares that progress to the 2% goal. Even subtle shifts in language about price pressures can nudge expectations for the path of cuts or a longer hold. The committee also weighs the labor market beyond the headline unemployment rate, looking at payroll growth, participation, and job vacancies. Signs of cooling without a crack are different from signs of stress, and markets price that distinction quickly. Growth data gets a close look, too. Household spending, business investment, housing, and trade paint the backdrop for demand and earnings. Stronger consumption with easing inflation supports a soft landing story. A slowdown alongside sticky prices argues for caution. Financial conditions are another key thread. Credit availability, lending standards at banks and non-banks, and the functioning of money markets reveal how policy is transmitting into the real economy. If credit is tightening on its own, the Fed may feel less urgency to keep policy restrictive. Balance sheet policy remains in focus. The minutes often hint at comfort or concern with the pace of quantitative tightening, reserve levels, and money market dynamics. Any signal of a tweak can ripple through term premiums, Treasury yields, and liquidity-sensitive assets. Why it matters for your portfolio is straightforward. Rates anchor discount rates and financing costs. A modest change in the perceived path for the federal funds rate can reprice bonds, mortgages, corporate borrowing, and the valuation of equities, ETFs, and even crypto. Banks can also adjust lending standards in response to the risks the Fed highlights. Your practical takeaway: read for tone as much as for facts. Words like progress, persistence, elevated, or balance of risks hint at timing and direction. Map that tone to your exposure to duration, rate-sensitive sectors, and credit. Stay flexible until the next projections arrive, because the minutes are designed to refine expectations in the meantime. Read the full article at finlitica.com.